All right, welcome back to the Main Management Weekly podcast. I'm James Maxwell, VP of Research, joined with
Alex Dippery, a research analyst here at Maine.
Let's go ahead and get into the presentation. So starting out here with the trailing week returns, pretty big risk on kind of move the last week, cyclical or pro-cyclical, pro-risk on. You saw commodities lead the way and small cap on the global index side, as well as infotech and energy lead the way on the sector side of things. Moving to the recession dashboard, no major changes here, kind of as is for the past couple of months. Moving forward, the big report that we had was the CPI number that came out. It's been the first kind of official federal government data point that's come out in several weeks now because of the government shutdown. This was kind of an exception because of things to do with the tips market, as well as kind of adjustments for prices. This was seen as like a very necessary data point, so it needed to be released even amid the government shutdown that's been stopping everything else from being released. The good news was it came in lower than expected. In other words, inflation continues to kind of chug along here at around a high 2%, kind of at 3% level. You saw that it actually reached 3% on the core CPI, and both on the core and the headline CPI are now at 3% year over year. We've kind of seen this, I don't know if you'd call it stickiness, but just kind of steadiness around, again, high 2s to kind of low 3% over the past year or so. Obviously, you have some tariff effects there kind of under the covers, and we can kind of get into it on this next slide here that looks at goods versus services. If you look at that solid orange line, you can see the goods prices year over year kind of hooking up over the past few months. A lot of that can be at least partially attributed to the tariff effects. But the thing is that we've noticed and we've seen when you look through the data, the tariffs are not really impacting the overall price level, like the overall CPI basket as much. Kind of on the margins it may be, but most of the effect of tariffs is more on the kind of relative price share. So what we mean by that is if you have a pie of, your income or disposable income, and tariffs are increasing the cost of, your imported goods, like your cars or your clothes or whatever it may be, that just means you're spending more on those imported goods and less on maybe the other things. Like you have less demand for services like, haircut or nail salon or whatever those other services might be. So it's kind of affecting the overall price mix shift versus absolutely making all prices higher.
Yeah, and I mean, broadly speaking, the inflation readings
Mm-hmm.
recently definitely give the Fed a little bit
Yeah.
more room to cut. Right now, we're at 2 cuts priced in for the end of the year, and then for the end of 26, somewhere between 4 and 5. But it definitely shifts the focus of the Fed a little bit more towards the
Right.
employment side, at least for the time being. So it gives them a little bit more room there.
Yeah, and I think even though inflation is running at 3%, it is a trailing kind of statistic. It's based off the 12 previous months. Policy is supposed to be forward looking. So the idea would be, if we cut policy, if we cut the interest rates lower, policy is kind of in a looser stance, allowing the labor market that seems to be kind of weak here. Obviously, we don't have the data for the last month due to the federal government shutdown, but kind of if you look at other indicators, seems to be weakening on the margins, allowing them to focus less on inflation because it's coming under expectations. Doesn't seem to be a huge kind of spike due to tariffs. It's more kind of on the margins, again, on the mix shift. So definitely some relief from the Fed there. Another kind of data point that we looked at was the Atlanta Fed's business inflation expectations. Tells a very similar story, kind of a steadiness of inflation expectations, at least at around 2.5%, 2 to 3% broadly, just kind of chugging along there. We also got existing home sales. These came in lower than expected, and overall, you've seen a kind of deterioration or just continued almost depression in the housing market, largely due to mortgage rates being so high. A lot of people locked into their low rate mortgages from previous years prior to 2022. The other thing that you have is just high prices, where even though you've seen, and this we can talk about this on the next slide, even though you've seen the mortgage rates come down here, to kind of mid 6% levels, which are the lowest in over a year, it's not really seen a big uptick in purchases or a big uptick in kind of home sales. This is a chart that looks at, on the right-hand side, this looks at refinances, and kind of applications versus actual purchases. And this is where you actually see a lot of the effect of those lower rates is those refinances, people kind of changing things on the margin rather than going out and buying a new home. And I think a lot of that is to do with the high prices that kind of, even though the mortgage rate is lower, the price you're paying, the effective price you're paying is still so high. So it's going to take some kind of more either lower rates or lower prices to actually drive those purchases higher.
Yeah, so talking a little bit about gold and silver, obviously it's been a major talking point this year. It's seen quite a rally. There's sort of been two core components to this, as far as gold goes. So primarily the structural force behind this rally has been central bank buying, particularly by BRICS countries, China, Russia, Turkey. Part of that is an attempt to diversify a little bit away from the dollar from some of our geopolitical rivals. There's also been a big retail push more recently, in gold, and that's, probably a lot of what we saw with last week's unwind.
Hmm.
We went from a point where gold is at a very elevated level to one of the largest single day
Hmm.
drops ever, and so you definitely had this sort of momentum unwind on that front. One thing I will mention is that those structural forces are definitely still at play.
Yep.
The central bank buying is part of a longer term macro shift, something heavily influenced by geopolitics, these countries' desires to not hold as many dollar reserves, which we can, use as a geopolitical tool when we want to, as we did with Russia in 2022. Um, and so there are these longer term structural forces behind gold, but for the time being, it was definitely getting a little bit overbought,
Yep.
and so that's sort of why you saw that pullback.
Yeah. I mean, when you see these assets, especially, traditional safe havens like gold and silver go, up, I think it was like 100% in the past year or two. It's not surprising to see a kind of pullback, momentum unwind, whatever you want to call it. Obviously, the tailwinds are still in place there, and why it's been up so much, but I wouldn't say it's like a break in any of the the theses there.
Speaking to volatility, we obviously saw a spike in the VIX, a spike in the economic policy uncertainty index. A lot of that was renewed concerns over tariffs, especially with China. That's coming a little bit as we've started this week, after the ASEAN meeting over the weekend.
Mhm.
Some better news coming out of there, maybe a little bit less concerning than expected on the tariff front. That's obviously something that we continue to watch very closely. Uncertainty's been a big driving force and theme this year for,
Mhm.
market moves up and down. And so, we continue to watch what's going on with China, but that's sort of why we saw that spike last week.
Yeah, it's so kind of funny, the classic climbing the wall of uncertainty. The markets just continue, the equity markets at least have continued to kind of march higher here, even amid, renewed worries about tariffs, China negotiations, the
Right.
Canada headlines over the weekend, like all of these things that continue to kind of uh, cause headlines, but not be reflected in actual kind of market impact.
Yep.
Another thing to look at here regarding the market, this is the AAII investor sentiment survey that looks at percent of bulls and bears. This is a good data point to look at to kind of see where the institutional sentiment is. And for all the talk of kind of bubble and frothiness, this actually kind of tells you that things aren't that extended, at least on the institutional sentiment side. Clearly, there are pockets of frothiness, like you can't really deny that. But even today, there's still in their survey, there's still more bears than bulls. The sentiment, relative to history, isn't particularly high. It's kind of maybe slightly above average. So I think that's just another data point to keep an eye on.
Yeah, and one thing I'll mention here, we've heard a lot of talks broadly of bubbles and melt-ups, and for what it's worth, the equity market performance this year has largely been driven by earnings.
Mhm.
In past bubbles, you see this sort of rapid multiple expansion,
Yeah.
and that's sort of where we would start to get a little bit more concerned, when we see equity markets continue to roar, but it's driven by higher earnings.
The fundamentals.
That's
Yeah.
yeah, that's something
Yeah.
that's a little bit more encouraging.
Yep. Lastly, here we also had the University of Michigan consumer sentiment, and this just continues to be relatively weak, even below 2022 or right around where it bottomed in 2022, below COVID, kind of very, very low relative to history. There's kind of one or two stories here. I think we've mentioned this a number of times, but this index has just kind of broken down its historical trends, kind of post COVID, for probably a number of reasons. One of which being they moved from phone surveys where they actually had the surveyors call you up or call a selection of people up, to now it's online surveys. And I think just kind of emotionally or psychologically, it's much easier to be negatively have a negative opinion or pessimistic when you're filling out an online survey rather than being spoken to on the phone. You also have a very high sensitivity to inflation. This kind of consumer sentiment index in particular is much, much more sensitive to inflation. And with the headlines, not only of the 2022 kind of inflation spike, but then the continued, somewhat stickiness here, paired with the tariff impacts or expected tariff impacts, you've just seen a lot of kind of things that make it hard for this index to do well. The one thing I will mention is that you look back at history, because this index has been around for, I think, 50 or 60 or 70 years. If you look at the times when it's bottomed, that tends to be a very good indicator for future equity returns when sentiment's actually at the absolute low and starts to spike back upwards. So you saw it in 2022. You've seen it in the previous kind of periods like COVID. So it's hard to say when that's going to be, but just something to keep an eye on. If you see the sentiment start to improve, it could imply a bottom, which historically has had these implications for stronger than average forward equity returns. And that's all for this week. The big headline was the CPI, which, as we discussed, I think was a positive signal for the Fed. Very, very likely to cut rates this week, and then the next meeting in December. So 2 for this year, and then over the next year, I think there's about 2 or 3 more rate cuts expected. Inflation continues to kind of be at that high 2s kind of level, even with the tariff impacts, because a lot of the tariff impacts have been more on the mix shift of prices rather than absolute level of prices. Housing market continues to struggle, kind of relying, even as mortgage rates come down, prices just continue to be too high for consumers. Gold and silver hit record highs, have seen some volatility recently, but there's a lot of kind of long-term geopolitical drivers to those, causing them to move higher over the past couple of years. And then finally, the sentiment has been mixed. You've seen not over optimism in the institutional side, and then the consumer sentiment has been very sensitive due to inflation and expectations. On next week, this week we have durable goods orders on Monday. So today, home price indices and the first estimate of Q3 GDP, which should be highly watched. We also have the core PCE on Friday, and this is assuming that the government opens up, which is a TBD. So we will see what data we get over the next week. If we do get any, or if the government remains closed, it'll be primarily those private market data points, which typically are soft data points like surveys and everything. So, Alex, do you have anything else to add?
No, I think that about covers it.
Great. Thanks all, and we'll see you next week.
Thank you.